What is it that makes infinite banking so desirable for so many people?
Options, options, options. People like having options, and with infinite banking, you have a lot of options.
One of the biggest benefits of using infinite banking is your ability to use the money while you're saving it for the future. And you don't destroy the cash value growth when you do this. If you try to do this with a bank account, you can put money into the bank account and earn interest on the money while it's in the bank account. But if you take the money out of the bank account to use it while you're saving it, you're going to stop earning the interest on that money. But with a policy that's designed for infinite banking, it's going to build equity in the form of cash value. You can access this money with a policy loan, and you don't lose the underlying cash value growth when you do this.
That accessibility is one of the big options that people really desire about infinite banking. I know that's what attracted us to it when we started doing infinite banking, Michelle. We were putting money and parking it in a self-employment retirement plan and an IRA when we first heard about infinite banking. And that money was just money that was denied to us until we were 59 and a half. It was money that we were earning and working for, but we couldn't access it. We couldn't use it. And when we understood infinite banking, we go, what are we doing this for? And we stopped doing that, and we started putting money in life insurance policies that we could access and not lose the growth on it while we purchased things that we needed for our family.
We're not just here to say that infinite banking is good and 401ks, Roths, IRAs, SEPs, they're all bad. It's just that those government plans can be good, but infinite banking allows you to be more in control and allows you to have more options for access and use during your lifetime.
Those plans, they're not a bad place to invest money, but they're a bad first place to save money because you can't get to it.
Well, and also, it's not really, those really aren't savings programs. Those
No.
are investment vehicles. And so you can put your money there and you can anticipate having more money in the future. But it also depends on what's happening with the stock market. And we saw in 2008, many people, the money that they had saved, but really invested in their 401k, those funds dropped dramatically. The joke used to be your 401k turned into a 201k. And while people would laugh just a little bit, many people were not laughing at all because, when it's your money and you're losing money like that, it doesn't feel good.
And it took people years to get back to where they were before that recession in 2008, 2009. And that means they're behind all those years because they only got back to where they were. They lost all the growth on it that happened between that time. That's one of the options that with a 401k that is limiting. And so when we do infinite banking, that growth is slow and steady. And I think of Aesop's story, it's slow and steady that wins the race.
Mm-hmm.
Most people, when they're saving money for the future, they have an idea that they're going to use this at some point in the future, but it doesn't cross many people's minds that they'll be able to use it multiple times in the future if they save it in the right place. And 401ks, IRAs, SEP plans that you mentioned, those are all putting your money away for most of your life where you're not going to use it. You're letting other people use that money. They're using it in the form of investments. You're hoping to earn a rate of return on that, but you're not using it. You're foregoing the use of your money during most of your life so that you can use it in retirement. But what if you were also able to use it along the way? Well, then you can use the money multiple times. As long as you pay it back, it should still be there for your future.
When you say pay it back, people go, oh, that's why I don't like infinite banking. But look, you're going to make payments on what you purchase in life anyway. You're either going to save up in a savings account so you can pay cash, or you're going to borrow someone else's money and you're going to make payments to them. And both of those cause you to lose interest, and one of them causes you to lose principal and interest. So one of the things that makes infinite banking so desirable is that you have control over your own money. And recently, one of our clients exercised that control and bought a motorhome. Michelle, you want to tell that story?
Yeah, Al contacted me and he said, "How much cash value do I have in my policy?" And I told him. And it turns out it was about 3 times more than what he needed. But he told me he was going to borrow the money. Then Al told me why he was going to borrow the money. You see, he and his wife live in Alabama, but their kids and grandkids live about 10 hours away. And his wife gets off work on Thursdays. But then she spends much of the weekend doing transcription work for her job. Well, Al decided that if he would buy a Class A motorhome, his wife could sit in the back, do her transcription work while he's driving, and they could end up spending most of the weekend with their kids and grandkids. So this is a great win for them. He can borrow the money, purchase the motorhome, and he's already thinking about what kind of payments he wants to make back. He gets to set the payment amount. And so then in future years, when he's thinking more of his retirement, that money's going to be there. And of course, he'll still have his motorhome, or maybe they'll sell it by then. I don't know.
So you just mentioned another option, and that's flexibility on the repayments. There's also flexibility on how you start funding your life insurance policy. You get to pick the premium that you want. And if you want to add more premium later, you can start another infinite banking life insurance policy. It's really, really the control here that you have as an infinite banking practitioner is unreal.
I doubt when Al started his policy years ago that he had in mind that he was going to be buying this motorhome. He knew he was saving it for the future, but he didn't necessarily know how his life was going to work out, that he's going to want this motorhome right here and right now. It's beautiful that he could have the option for doing that. He didn't have to earmark that savings. This is just for retirement. I'm not going to be able to access this for a long time into the future. No, he can take the time to buy the motorhome now and still have the money for the future. That's a beautiful option with flexibility that he has with infinite banking concept.
Yes, and it's nice because it's flexible with his finances, but it also makes his life more flexible. They get to see their kids and grandkids more often, and he's excited because he's expecting another grandchild this summer. So they're going to go and park the motorhome and hopefully be there for that birth, be able to rejoice with the family as that new baby comes. So it's making their life more flexible. It's giving them more life to enjoy during their living years.
This is reminding me of another story about flexibility. Sam in California was buying a house, and they had money that they had built up in their life insurance policies by paying premiums. So they had equity, cash value there. They took a policy loan to make the down payment on a new home that they're moving into. Well, moving to a new location, that can change cash flow. So Sam doesn't know exactly what cash flow is going to be looking like over the next few months. So we talked over the phone. Sam decided he's going to pay interest-only payments on the policy loans that they took for the first year. They're going to see how cash flow settles out after their new move, and they might have some extra repairs and whatever to make to this home. And then they can evaluate their cash flow about a year from now and see, okay, how much principal do we want to repay on this loan? That's flexibility that you don't get with most bank loans anymore. Interest-only loans aren't as common right now.
You know, the future is unknown to all of us. We can plan for it or try to plan for it, but there's always something that comes up that we had no idea that was going to happen. And Michelle, when we started Jesse's policies when he was a little tyke, we had no idea that he was going to use those cash values to purchase his first house. And yet he did. And now he's in a position where he finds out that there's a little bit of remodeling that needs to be done on that house, more than what he expected.
There was a lot of remodeling.
Yeah, actually, he knew there was quite a bit of remodeling. Yes. The home had originally been a barn and been converted to a home, but not very well. And he got in, he knew there was going to be remodeling. He started doing demolition, and, they would start building things. And then they realized, oh, wait a minute, this has got to go too.
There's a lot more remodeling that needs to be done to make this really
a lot
safe and where we want to live.
That's right.
Yes.
And he had the funds accessible to make those decisions so that he could make the home even better than what it was going to be. But it ended up costing more than he anticipated.
And being he's doing a lot of the sweat equity himself with his brothers and family, it he hasn't had a chance to be able to produce as much to live on. And so it's very convenient, it's very flexible for him just to pay interest on those loans right now so that the balance doesn't continue to compound against him. And when he gets back into being able to be more productive as far as creating an income, he can repay those loans. And when he does, he's going to have his house, which is a very nice house, and he's going to have all the money he paid, instead of it going to a mortgage company, is going to come right back, and he's going to be able to use that money again.
A lot of people, they don't want to be in debt to anyone. And so taking a policy loan, are they in debt to the insurance company now? Well, no, because it's money that they had put with the insurance company ahead of time. So that it's a fully collateralized loan when you look at it that way. You're not taking additional risk on by borrowing the money from a bank.
People say, well, I'm going to die someday. What's that going to do to the death benefit? Well, you've already received some of the money in advance. So the loan will be taken care of, and there will still be plenty of money for the beneficiary of the policy. So
That's right, because the death benefit's always going to be more than the policy loan that's outstanding on a policy. Mm-hmm. And that's one of the options of the flexibility that this gives you. Not only do you have flexibility in how you repay the loans, but sometimes you can have flexibility with how the premiums are paid.
Sometimes people will choose to pay annually, sometimes monthly, but then there's a couple of different parts to the premium. And so there's options there. So sometimes people, have a little issue with funds being tight for one reason or another. We saw this a lot in 2020 when people's jobs situation changed, everyone was staying home. And so there is flexibility there too. And so, we can just work with someone if they're ever having troubles figuring out, what's my flexibility here? They just call us. We can help them figure out what that flexibility is.
Recently, we had a client that was involved in real estate most of her life. She's retired now, and she has a policy loan, and she was planning out how she was going to repay it. And then she called the office, and she said, no, I'm going to skip this payment. And then later she called back, and she says, yeah, just make this an interest only for a while. And because I know there's a lump sum coming in, I'm just going to pay the loan off all at once. That flexibility is so important, especially in a business situation. You take out a business loan and you want to repay that loan early, they make you pay the interest. It's a penalty that you would have paid, or a big portion of that interest. You don't get off the hook that easy on a business loan.
When we get back from the break, we're going to talk about more reasons that infinite banking is desirable. And if you think we have more great real-life stories to go with it, you are right.
This is the Infinite Banking Made Simple binder. Everything you need to know about infinite banking in one spot. And it's a free download. Answers to the top commonly asked questions like what is infinite banking, how does it work, and how much does it cost to get started are answered right here. You'll find the step-by-step diagram starting on page 7 and the investment comparison on page 8. This Infinite Banking Made Simple binder is a free download. You can click the button to get your copy. At McPhee Insurance, we believe infinite banking has become too complicated and confusing, but it shouldn't be. And that's why we created this binder. Infinite banking is simple when you stick to the essentials and the facts. And the people who put it into practice get results. Don't let insurance terms like modified endowment contract, 7-pay test, direct recognition, and paid-up additions keep you from understanding infinite banking. Download the free binder and see how infinite banking can work for you.
Banks supposedly loan money out that was deposited into their banks. Banks actually create money when they provide credit to a consumer.
Sounds wild to think that banks are actually creating money when they make a loan, but this has been documented, where you look at the balance sheet of the bank, and when a new loan is given, they have actually extended their balance sheet. They created that money out of thin air, whereas insurance companies and other financial companies, when they make a loan, that it's coming from their assets in some form or other. Usually it's coming from their reserves. When in the case of infinite banking, when we're taking a policy loan, the insurance company has to keep a certain amount on hand in reserves, earning a relatively low rate of interest. They have to keep this money on hand. They might as well lend it out to policy owners. And so one of the things that we look at when we're looking at companies that are good for infinite banking is what companies have a relatively high level of reserves that they'll be happy to give to policy owners as they're taking policy loans.
Yeah, so basically when you take a policy loan from an insurance company, they are putting you and making you part of their portfolio so that that insurance company can make more money. And that's why it's important that we try to work with companies that pay dividends, because I just learned this last week, 90% of the profits of an insurance company have to be shared back with policyholders. So after they pay their business expenses of running a company and paying their mortality expenses, paying commissions for people that are selling their products, 90% of what's left over, they have to give back to the policyholders. And that's why the IRS calls that a return of premium. Because they really say, the IRS is saying, you really didn't need to charge that extra amount that you made. But in reality, they did, because they couldn't have made those investments and made that return without that money.
So 90%, that's pretty high.
It is.
But that doesn't mean you as a policyholder get 90% of the dividend. There's other factors that come into play. How long you've been with the insurance company, how much you've paid into the insurance company, how much death benefit you have. So what your share is in with the company.
It's shared proportionally to how much risk my life, my insurance policy poses to the rest of the insurance pool. So if I paid just a little bit of premium, the risk on my life is very high because my death benefit has to be paid out if I die, and it's much larger than what I've paid in premium. The longer I own the policy, the less risk I pose to the insurance pool, and the higher percentage of what that dividend is declared to be every year is what I get. So it goes up every year.
And different companies have different ways of figuring that. And that's why you said you want to be with a company that pays dividends, and you want to be with a company where those dividends actually translate to increased cash value. Some companies will show a high dividend. They might pay it out if you were taking it in cash. But when you look at what it's actually doing, if you have it go to add to the paid up insurance in the account, that's what helps a policy to really grow and do well for infinite banking. Sometimes when you look at that, the dividend isn't translating to a lot of value that's purchased in the policy. And so you want a company that's paying dividends, and you want a company where that is efficiently translating to cash value. That growth that you get in the policy, that is tax deferred growth, which business owners just love, because you think about tax deferred growth anywhere else. If this money was in a 401k or an IRA and you're getting that tax deferred growth, you're going to pay taxes on it when you draw it out. Well, business owners, they don't want to wait all the way to retirement in order to be able to access the money they're putting away. So with a life insurance policy, they're putting money into a life insurance policy. That tax deferred growth builds up. Well, do they have to pay taxes on it when they go take a policy loan? No, that's different, because they can take a policy loan. A loan is not taxable. They can access the whole thing, all of that cash value, without triggering the taxes on it. They can pay it back without triggering the taxes on it. And so this is a hybrid sort of account. When we think about the different types of accounts and the way that they are taxed, you can have an after-tax investment account where every time you sell something in an account, you're going to pay the taxes on the growth. That's going to be like a typical brokerage account. You can have tax-deferred accounts like a 401k or an IRA, where you can buy and sell different investments in those accounts. But if you take the money out, you're going to pay taxes and often a penalty associated with that. Those are what most tax-deferred accounts are. Then there are tax-free accounts like Roth IRAs, where you put money in that has already paid taxes, after-tax contributions, but then everything you take out years down the road, qualified distributions should be tax-free coming out of those accounts. Life insurance is kind of a hybrid between all of these. The premiums that you pay in to a life insurance policy are after taxes, kind of like the contributions that would go to a Roth IRA. If you build up the value in the life insurance policy, you can take policy loans against it to access it. You can pay those back over the years. If you let the death benefit go to your heirs, then it goes to your heirs income tax free, very much like a Roth IRA. But if you take the money out in retirement, let's say you take withdrawals or move that money to an annuity, then you may pay some taxes on the growth. The tax deferred growth, kind of more like a tax deferred account. But life insurance is a hybrid between these accounts. It gives you more options as you're thinking about your strategy for accessing and using your money during your life and in retirement.
I'm thinking one of our clients, a group of brothers and uncles, and they're all together, cousins, and they own this company. And they wanted to make sure that that company wasn't damaged financially if one of those partners died. So they bought life insurance because life insurance is one of the best ways to fund an exit strategy of a business. You die, that death benefit's there to buy the partners out so that your spouse or the rest of your family isn't stuck trying to come up with money to pay off those stocks. So recently, this group decided they needed some equipment, and each of the partners loaned money out of their policy to the business. Now, this didn't put the business in any credit risk or anything, and yet they still get the same tax deduction for the interest they pay back to each of these policies. So not only does the business get to write that interest off on their K-1, they get it listed, but each of the policyholders that loan money to the business gets to claim that interest as a personal tax deduction. So this is a beauty, and one of the things that makes infinite banking so desirable for business owners. They understand that they don't lose the interest deduction that they would if they went to a typical bank to get a finance package.
If the business went straight to the bank to get this loan, the owners are probably going to have to co-sign on the loan, put their personal name on the line. The business is still going to be able to deduct the interest that they pay to the bank, but they get no deduction on the personal side. When you take a policy loan from the life insurance company, there's really two loans that are involved because the life insurance company is lending you the money, and then you're turning around and you're lending that to the business. So there's two sections of that loan. The interest that the business pays to you, pays back on the loan, that's a tax deduction for the business, just like they would have paid it to a bank. But then when you turn around and you pay the life insurance company back, there's interest on that loan. That becomes a personal tax deduction because you borrowed for a business purpose. You can get the same deduction if you're borrowing to make an investment, and the investment is offsetting the interest that you're going to pay to the insurance company. It's the same tax deduction.
So with a typical bank loan, a business owner would never see the money that they paid back to the bank. It would go to the bank. The bank then would control that money and keep it circulating and make money for the bank. In this situation, in this business situation, the business owners recover the money. So they don't make money like a bank does when they make a loan. They recover money that they spent. And now that puts you in a position to make money like a bank does.
We've been talking about access and control and flexibility. And one of our clients, Randy, he's really glad that he used infinite banking and was purchasing whole life policies rather than a Roth IRA because he recently looked at his son's situation. His son is starting a business and trying to work that business. And Randy's looking at the housing market nearby. Housing market is difficult for young people to get into. He doesn't want his son to decide, oh, I'm going to try a different market, move halfway across the country with his grandson. So he thought, wait a minute, what if I access my cash values in my policy and purchase a home that my son can live in? He can pay me rent. I talked to him about interest-only loans. He liked that idea because it gave him flexibility on how much he could charge his son until he sees that the business is doing better. And so now he gets to offer his son a place to live nearby so the grandkid doesn't have to move across country. And he's helping his son out as the business gets going. Eventually, his son will be able to take over those payments, or maybe if he decides he wants to move, he can move and Randy can still sell the house. So he has lots of options. But if Randy had put his money into a Roth IRA, there would have been more limitations. You cannot borrow from a Roth IRA to purchase a home that is going to benefit one of your family's members. So you can't have family live in that home. So Randy is very grateful that he purchased those whole life insurance policies. He's used them over the years, paid money back over the years. But now, again, he can tap into those resources and purchase a home that makes it convenient for their family. So he's using the money he stored during his lifetime to help his family while still leaving cash cushion in his policy for other things that come up. And he is getting to meet their needs.
That's wonderful. Really, the only people that we find who don't like infinite banking, we'll hear those people and people that are listening to them say, well, insurance agents are promoting infinite banking concept because they're going to earn a commission when they sell a policy. But all the people that we hear that are against infinite banking, they usually have a vested interest in not understanding infinite banking. Maybe they have a program that they're trying to sell you, or maybe they want you to invest money that you would typically put toward premiums on an infinite banking policy. They want to invest it with them so they earn a fee off of it. Or in the case of the banks, they want you to keep borrowing from the bank and be dependent on the bank. Sometimes it makes sense to do that when interest rates are low, but when interest rates are high, you want to have other options. You need to prepare those options ahead of time. So really, when people are against infinite banking, there's usually a financial reason. Maybe they just lack the imagination to know that they could put money away for the future and then be able to use it along the way. Sometimes that's a factor. Sometimes it's a lack of discipline. They know that if they took a policy loan, they would never pay it back. They just don't have the discipline to get their financial life in order. Some people are in that situation. And other people, we see that delay getting started. It's almost like they don't want to think about it. Like thinking about life insurance, they're suddenly going to die. They're going to put a hex on it or something. And so they're just kind of in the stage of avoiding reality. Those are the people that we see that don't like infinite banking. The people that really think through it thoughtfully and want to save their money in a place where they're going to have access to it over the years. Those people love infinite banking.
I think some people too are a little afraid that they're doing something different than other people might be doing. And they feel like there's safety in numbers. Oh, everyone's talking about a 401k. That's what I should do. Or, oh, it seems like everyone's investing in real estate. That's what I should do. When really there's not just one thing that fits everyone, but in their mind, they want to stick with what it seems like everyone else is doing. But the reality is, do you really want the results that all those other people are getting? And that's something that you have to decide for yourself.
Infinite banking is very desirable. And from the stories we've shared today, you can see why.
Infinite banking is used by people in all walks of life. So whether you're just getting started or getting near your golden years, infinite banking could be useful to you.
At McPhee Insurance, we specialize in designing policies that are great for infinite banking and helping people figure out what's going to be right for their situation. So give us a call at 317-912-1000. Next week, we're going to be talking about velocity banking right here on Wealth Talks.